Have you ever wondered if even the best intentions in government spending can sometimes have unintended economic side effects? When governments decide to boost the economy through increased spending, they often need to borrow money to do so. This can set off a chain reaction that directly involves interest rates and a concept known as the crowding out effect. Specifically, higher interest rates tend to worsen the crowding out effect. When government borrowing increases, it raises the demand for loanable funds in financial markets. This heightened demand, without a proportional increase in the supply of available funds, naturally pushes up the price of borrowing, which is the interest rate. Consequently, these elevated interest rates make it more expensive for private businesses and individuals to borrow money for their own investments, such as building new factories, expanding operations, or buying homes, thereby reducing private sector activity. The core mechanism behind this relationship lies in the market for loanable funds. Think of it like any other market where buyers and sellers interact. The government acts as a large borrower, competing with private businesses and consumers for the limited pool of savings available for lending. As the government's demand for these funds grows, the equilibrium interest rate, which is the cost of borrowing, rises. This increase in borrowing costs then discourages private investment, effectively reducing the overall economic stimulus that the government spending was intended to provide. For economists, understanding this dynamic means looking at several key factors. We analyze the elasticity of the supply of loanable funds, which is how responsive savers are to changes in interest rates. In an economy operating near full capacity, with less slack, an increase in government borrowing is more likely to significantly raise interest rates and crowd out private investment. Conversely, during a recession, when there is an abundance of idle resources, the crowding out effect might be less pronounced as the supply of loanable funds can expand more easily without drastically increasing interest rates. It is also important to consider the size and duration of government deficits. A fascinating detail for those studying macroeconomics is the concept of Ricardian equivalence, which suggests that if individuals fully anticipate future tax increases to pay off government debt, they might save more and consume less today, potentially mitigating the crowding out effect. However, this is a theoretical ideal. In reality, the extent to which government borrowing crowds out private investment depends heavily on central bank policy. If a central bank expands the money supply to accommodate government borrowing, it can prevent interest rates from rising, though this might introduce other risks like inflation. This interplay between fiscal and monetary policy is critical in determining the actual impact on economic growth. Ultimately, recognizing how interest rates influence the crowding out effect is essential for evaluating the true effectiveness of fiscal policy. It highlights that government spending does not occur in a vacuum. Its financing can have profound implications for private investment and long-term economic growth. Understanding this intricate relationship allows us to appreciate the complex trade-offs involved in managing a national economy, helping you confidently navigate challenging coursework and real-world economic analysis.